All right, without further ado, let's start. So my name is Jonathan Legrand. I'm a developer advocate at Refinitiv, which entails that I write a few articles on our developer portal, and you can find a developer portal right here, boom, on developers.refinitiv.com. So if you've got any questions, if you're wondering what we're doing here, and if I mentioned words that don't seem too familiar, it's probably because we're talking about some products maybe that you can find on developer community. If you were to scroll down here, you'll find enough information about pretty much anything. Maybe you'd be interested in APIs. So today we're going to be using Datastream. Datastream is just one of the data providers that are out there you can get, and this one specifically uses a Python API called DSWS, and that's what we're going to be using to just collect what's called secondary fixed income market data. So if I go back to my code, this is one of my Refinitiv academic article series in Economics and Finance 101. And you can see that it's part 2. So it's computing risk-free rates and excess returns part 2, because there was a part 1 before looking into zero coupon bonds. And what we did here is that we did some very lambda, very well-known academic work on risk-free rates, on sovereign bond rates, and I gave an example of the Fed, the US government bonds usually given out. And this is very kind of lambda, and everyone knows about it. And I've given 2 different ways of computing them. One of them is the lambda way to do it, the easy way to do it. The other one is a little bit more tricky, and I actually don't think it is too good to use either, but it is an interesting one just to look at the case study. But I got even more interested because the reason I did this second one was because I wanted something more realistic. The first way to compute yield to maturities of bonds is quite academic and theoretical, and I'm going to be talking about this. And I've decided to do something much more down to earth and put ourselves in the shoes of an economic agent that would be looking at investing in those so-called risk-free rates, or so-called much of anything else really security-wise. So here we're going to be computing risk-free rates and excess returns. This is part 2, whereby we're looking at sovereign coupon-paying bonds. And I'm going to be talking about bootstrapping and spot rates. Now, we're actually not going to be able to, we're not going to have the time to go all the way to the part where we start computing risk-free rates. It's quite a lot of code to go through, but we are definitely going through the coupon bonds and the bootstrapping and the spot rates. All right, so this is, as I said, a continuation of the previous article where we looked at the net present values, face values, and all of these things, a lot of the lingo. I will assume that you know what these means, or at least to an extent, specifically to do with bonds. So a bond being a debt given to you by, if it's a sovereign bond, by a government, or it's not technically a government, by a central bank, an entity that normally represents a government, such as the United States of America, maybe France, maybe Germany, maybe Turkey, Armenia, whatever it may be, Russia, China. They all have debts that they give out so that you can buy on the stock market, on the open market, and it's actually extremely difficult to get them first. So if, for example, the federal government decides to, if the Fed decides to sell debt to people in the market, it's extremely difficult, if not impossible, for just me, for example, to just buy them off the US government, of the Treasury. You'll have to go through an intermediary, and normally the Fed sells them to intermediaries that are investment banks, or maybe some asset managers, some large ones, and then you can buy them in the secondary market from them. That's what I'm going to be looking at. And normally what you do is that you use this to compute what's called a risk-free rate. Now, there is no such thing as a risk-free asset, but it's a theoretical benchmark that you can use to hedge your risk. So if you think that you're doing something extremely risky, and you want to make sure that, if your risky strategy was to fail, maybe you'd want something to fall back on. And that's fair enough. And maybe something you want to fall back on is something as riskless as possible. And normally that's a government bond, because you think that, what are the actual chances that the US government is going to collapse within the next however many future time periods you're looking at. So you can buy such debts, such bonds. You can buy them in any maturity. So maturity is how long the debt is for. So you can buy treasury bills, they mature at 1 year or less. Treasury notes, they mature at 10 years or less. Or treasury bonds, they go all the way to 30 years. You don't have to stick to US stuff from the treasury. You can go for United Kingdom ones, Japan. There's Eurozone government bonds. There's loads. But I'm just going to give an example of the US, because that's the kind of the default world reserve currency. Now, I speak about this in detail here, and it is already, all of this is already in the previous article looking at zero coupon bonds. Things are very, very similar in the article to the zero coupon bond article up until this there right here, and up until this spot. But nonetheless, I wanted to go very quickly through all this. We're going to be computing what are called yield to maturities. Yield to maturities are computed as per this equation. To let me know if it's too small, I'm going to zoom in just a bit more just for the equation itself. You can see that we have what we call a net present value. So that's the fair value that we normally associate with a bond according to its cash flow. And the cash flow is how much is going to be provided from this debt throughout the years. You can have zero coupon bonds, as I've mentioned before. Zero coupon bonds, what they are bonds that do not give you any payments apart from what's called the face value, which is the end. So there is famous zero coupon bonds, such as the 1 month Treasury note, and those are given by the US Treasury. They mature within 1 month, so after 30 days, I think they are always 30 days, you are given $100 by the Fed, and that's it. There's nothing else to it. They don't provide you with any coupons, with any payments in between the two, in between the day you buy the bond and the day it matures and you get your $100. There's nothing in between. That's a zero coupon bond, and it doesn't have to be 1 month. It can be I think there's 2-month one, there's a 3-month one, there's a 6-month one, and there's a 1-year one, and that's the maximum one you can get from the US Treasury. And those are quite simple because there's no coupons being paid between the time of issue, so the time where the bond is sold at the very start in the primary market, and the time when the bond matures, which is to say, this $100 are given back to you. Now, I was taught in the past that they were actually $1,000 face values, and I've only actually seen in the secondary market $100 face value. So I don't know what the discrepancy is about, but I mean, we're talking about something very simple to manipulate in mathematics, just a factor of 10, so it's not too bad. You just have to multiply whatever you do by 10 if you really want something 1,000 as opposed to 100. But this is what we consider to be our fair value, this net present value that we've got from our cash flow. And here on the right, you've got C, and that stands for the coupon. And that's the coupon paid by the bond every time period. The time period can change depending on the provider of the bond, but usually it's every 6 months. And I will just assume it to be 6 months all the time going forward. When I make that assumption, I make it very clear and I write it down. This little FACF that comes up stands for the, let me make sure I get that right, annual compound frequency. That's what I called it. And the reason why this is important is because you might want to compound your interests at different frequencies. So some people, for example, want to get their cash flow after 6 months. They're given a coupon from the bond and they want to reinvest it. And that means that you get compound interest. If you were to do this, if you were to then look into the future and you were trying to discount the cash flow to today, so for example, if you're trying to figure out a net present value of a future cash flow, which is exactly what we're doing here, you'd want to inverse this. You'd want to say, okay, well, I want a lot more information. I want a lot more from what I'm paying because I would expect to be reinvesting it every 6 months. And that's this FACF. This is the frequency at which you expect to be reinvesting your returns every 6 months. Well, I say every 6 months because that's what I'm going to be doing here. And that's your compounding interest. And this compounding interest does not only factor in with the coupons, but also with the yield to maturity. And the yield to maturity is this I said about discounting. It's your discount factor. It's by how much you expect to be reinvesting stuff in your cash flow throughout the years, and that's your yield. This on the right is within a summation. Each part of a summation is called a summand, just to let you know, because I'm going to use this lingo coming forward. And this on the left is not part of the summation. It's what's called the face value of the bond. So I'm discounting it, as you can tell, with the yield to maturity at the bottom. And we're putting it to the power of whatever it is that we're looking for in terms of time periods. So here, M is the maturity. FACF is also, again, the annual compound frequency. So this frequency is actually quite important. And that's one of the things I did not find anywhere else. That's why I wanted to write an article about it. No one talks about it for some reason. So this one at the top is the more interesting of the two equations that come into play when we're talking about net present values. And you've got this top one that looks into when you have a maturity that is higher than your annual compounding frequency, which is the case most of the time if you're looking at coupon paying bonds, because you tend to have compound frequencies that are of 6 months, and usually coupon paying bonds have maturities that are higher than 1 year. So it's usually the case that the top equation is the one you're looking for. But the bottom one is, feasible. It can happen, in which case I wanted to put it in there for you. And you can see that all you do is it's just a straight line. There's no compounding. There's nothing too complex there. It's just a straight line. Face value plus coupon. You've got your maturity in there. You're just calculating it, extrapolating your yield to maturity from there. Fair enough. And I speak about all this, what I've just said, right here and right there. Compounding, discount factor, all these things, and comparability. Now, you may be wondering, why are we doing all this? Why are we trying to compute a yield to maturity? This seems kind of archaic and all this. Well, actually, it's because if you were to compare the net present value of a bond, let's say a 1-year bond and a 10-year bond, well, a 10-year bond is always going to be worth more because it's going to pay more coupons through time. It's going to incorporate more information about the future. So, for example, if we expect, we're in COVID right now, there's COVID-19 happening, and we expect things to get better in 10 years' time than today, or than in a year's time. So you'd expect the net present value, or at least the price of a 10-year bond to be higher than one of a 1-year bond for all these factors. As a result, you can't compare them. You can't compare a 10-year bond price with a 1-year bond price because they have different what we call term structures. So one matures in 10 years, the other one in 1 year. If that's true, then we can figure out a way we can figure this number by which we can actually compare each one of the bonds. And then with this yield to maturity, you can start comparing a yield to maturity for 1 year, for a 2 year, for 3 year, or even maturities, bonds that are of different countries or different issuers. And that's why we compute this yield to maturity, is because we can actually compare stuff. And then once you can compare them, you can see that one may be overvalued or undervalued. All right, moving swiftly onwards. I speak quickly about the fact that the coupon paid by a bond, in our case every 6 months, is to the issuer, by the way. It's paid to the issued. So if I was to buy a bond from the Fed, I would be the one receiving the coupon payments every 6 months until it matures, and then when it matures, I get the full fat of the bond, which is usually $100. And when you're talking about coupon payments, when you look online to try and find information about how much you would be paid, unfortunately, it's not given in like dollar terms. It's given in percentage of the face value. And I think they do this in order to be able to compare these coupon percentages across the line. So if I'm looking at one that's in euros, in one that's in US dollars and things like this, you can't really compare them to each other. Whereas here, it's a lot more straightforward. By the way, it seems like my stream is maybe flashing or something as such. It's just looking like there's like a probing effect of some kind. Do let me know if this is happening on your end. I might have to switch it off and on again or something as such. It goes from black to gray and then back again. Do let me know if you have an issue seeing it on your screen. So I'm going to give most of the time an example of a 5-year treasury note in order to have something that's a bit complex. 5 years is not too small, so this is when coding comes into play. Otherwise, you might do it by hand, right? It's quite easy enough, but once you start, going through 5 years, apparently you don't have an issue viewing my stream on your end, so that's good. Yeah, so when you go to 5 years, it's actually quite difficult to compute it in your head. No one really would do that. So I've done this on purpose. And then I've given a little example here, quickly to show you how one would compute a net present value with information from Datastream. And this is when the code comes in, and that's when I get quite interested and excited. Here we've got our data provider, so that's Datastream, and Datastream has a Python library called DSWS. And I don't want to write Datastream DSWS every single time I call for information on the API, so I import it as DSWS. Once I do this, I have to authenticate myself to the DSWS, and I do this with a username and password. Now, obviously, I don't want to share this on Twitch, so I've just put it in a file alongside the one I've got here, and that's what this code does. It just makes sure that I don't have to show all of my credentials to everyone. And once I'm authenticated to the API, I package everything into this one Python object called DS. I've just called it DS because like this is very quick to type, just two letters. All right. So moving forward, I collect. So what's that? That's going to be 5-year treasury note coupon, so it means that it's coupon paying bond, and it's issued on towards the end, the end of July 2020. And underscore P stands for price. So I'm looking for the price data here, and you see that there we go. I've collected price data, and here I'm looking for specifically the price at time of issue. So it was issued on the 30th, and I'm looking at that specific price. That's not all the information I need in order to compute the net present value, or indeed the yield to maturity of my bond. I also need not just price data, which changes with time, right? If I scroll back up, you can see that the price changes every day, but also something called fixed data. And fixed data are the innate properties of the bond. So if I scroll down, I can get this fixed data. That's why there's underscore F here in my code. By the way, this whole code is going to be shared on GitHub when the article is published. This is just a little streaming test to see if anyone's interested in seeing how one goes about thinking about writing these articles and the logical process that goes through writing these. So yeah, here I've got my 5-year treasury note, coupon paying note with this issue date, and I have innate properties that do not change with time, such as the issue date itself, which is on the 31st. Term, so term is the yield to maturity, the years to maturity as of time of issue. So I know that this specific bond is issued on that date and matures 5 years after that date. So that's what the term is. So if I talk about years to maturity, the years to maturity change every year. So for example, if I was to buy it on, if I was to buy this bond at the end of July 2020, then on July 2021, the years to maturity is not 5 anymore, it's 4, because 1 year has gone by. However, the term of the bond does not change, because that's just an innate value of the bond, right? It doesn't change. However, the years to maturity change every year, change every day, as a matter of fact. RV, I think, is the redemption value, must be $100 here. Coupon is the coupon percentage rate, as stated in percentage of the face value. So that's 0.25%. The coupon type is fixed. So to start with, I'm only going to be looking at fixed coupon types, because otherwise it's going to get really complex if we look into floating ones. I do want to add floating coupon percentages later, maybe at the end of the article, or maybe in the next article, either or. Here, this is the what's this one? It's the redemption date, last. So L is at the end, last redemption date. So basically when it matures 5 years later. And these are the exchanges. I don't know why I added that in there, just to show you the kind of information you can get from Datastream. Once we have all this data, we can put it all together. We can input all of this data into our previous equation. If I scroll back up, this is it. This is our previous equation, specifically looking at the net present value of our 5-year treasury note bond with semi-annual compound frequency. So you see here 0.5 stands for half a year, so 6 months. Semi-annual, it's a semi-annual compounding frequency. And there's a comma T here to show you that it's at a specific time. So this is the net present value of this specific bond at that time, at time T. So if I scroll down, I've inputted all of all of this data. You can see that it's not comma T anymore, it's comma 2020-07-31. So I'm looking at the actual date of issue, and I'm putting all of the information in, and then calculating the yield to maturity. However, if I look here, you can see that this is the yield to maturity equation, and there are 2 of them. As a matter of fact, there's 10 of them. Yes, there's 10 of them. There's 10 yield to maturities. Now, they all have to be the same. They all have to be equal to each other, but I can't put the yield to maturity to the left of the equation with the rest of all the numbers on the right. So I can't actually compute it. I can't calculate it myself. I have to go through an iterative process. I have to input a number as the yield to maturity, let's say 1. And then I look at whether or not this whole equation is equal to 0. If it isn't equal to 0, I know that I got the incorrect one. And then I try another one. I try, okay, what about yield to maturity 2? What if yield to maturity is 2? Does it work? No, it doesn't work. And then you continue like this trial and error, trial and improvement until you get a number that's sufficiently good to give you something close to 0, if not 0. And that's what I've done here. So instead of doing it myself manually, I've used a Python library called SciPy, in which there is a sublibrary called optimize. And if I scroll down, you'll see, there it is. You've got optimize.newton, and there's just a Newton technique developed by Newton to iterate through these things and go through a trial and improvement method to get these types of values. And that's what I'm doing here. You see that I've just basically put into Python the equations we had at the top. So if I scroll back up, this is it. This is the equation I have. Actually, I've generalized it. So this is the equation we have down here. There. It's returning it in this yield to maturity equation, and then at the bottom it's telling you which optimal yield to maturity, and that's the one it's giving you. And we can see through this little method, once I use this Python function that I've created, I have a yield to maturity of what was this 0.0022955, and then there's some more at the end, and there's an error. Now this Python code is not going to be perfect, especially if you do this trial and error iteration, trial improvement iteration. You'll always have some leeway, and here you can see that it's quite good actually. We're looking at something times 10 to the minus 14, so we're looking at 0.0000, and there's 13 zeros, and then after the 13th zero on the 14th decimal place, there's a 1, and it's 1, 2, 4, 3, 4, 4, 9. So we're quite close to 0. I'm quite happy with this error, and it's telling us that this yield to maturity is pretty bang on. So this is it. This is the yield to maturity for a 5-year treasury notes issued at the end of July 2020. Now, all of this had to be done just to figure out the yield to maturity of one bond. And that's why I created a Python function, so that it does it for you without you having to think about it all, without having to search it all. Matter of fact, you might be wondering, how did I find this 5-year bond? If I scroll back up, if I scroll back up, scroll too far up. There you go. Here it says that the ticker is this. Now, if I go on Datastream, I'm just going to log in on the other screen for you. Give me 1 sec. So what I'm doing right now is I'm going on Datastream Navigator. If I can find it, that is. Ah, there you go. So if you go on products.datastream.com, you will be greeted with this with a authentication window in which you'll have to put your username and password, and you can search for instruments in there. So here, for example, I searched for that instrument. I found that instrument anyway, and if I look for it, you'll find in the navigator. This is what I was looking for: a U.S. Treasury note issued in 2020. It happens to give me the fixed coupon rate. I don't necessarily want it in there, but it just gives it to me. And then its maturity date. Okay, so that's the US Treasury note that I found, but you might be wondering, how did I find it? What did I search for? You can go ahead and search for stuff in there. So for example, if I was to go there, if I do US Treasury note, then I don't know, 31st of, I have no idea, 2021, why not? I don't know if there is such a note. There you go, there's none. Let's go like this instead. There we go. So this is a US Treasury note. What's that? 2021 to 2014. That's another 5-year one. So there you go. You got a 5-year one with a 2.25% coupon rate. You can find all the coupons in there, and these are all secondary market ones. So you can actually go in the market and buy them with a price that changes every day. So that's how I found the one I was looking for. And once I did, I used the code that you can find right here in my DSWS Python function. So if I scroll back down, I did all of this math. I found my yield to maturity, but you can also automate the search. So if you know what you're going to be searching for, I'm looking for US Treasury notes, and you know when it ends, and you know when it's issued. Let's say 2014 up, and you know that it's always going to come up with one solution only. It often does. Then you can use this field in the DSWS get data function to automatically search for you. And that's what I've done here. So if I scroll down, we should be able to see it. There it is. So here you see what I've done is I've used my ds.getData function with a specific ticker, and search term, not a ticker. And that search term is going to be, for example, US Treasury note 2014 310721. And in the fields, I'm going to use this field, and that's a little trick for you. It looks for bonds and convertibles only, and it will return what I look for. So here, what did I ask for? What did I ask for here? The instrument value. So it's going to give me the instrument value. There you go. There it is. And then I can run all of my code into this one function that I've created. So you can see if I scroll back up, I've defined that function so that I don't have to rewrite it every time. I said def space that I've created this whole very long function, and it does all the work for me without having to rewrite the code all the time. And here it is. It gave me the results for all the bonds that are related to my search. I'm just going to need to drink whilst I talk because there's quite a lot of talking going on. Yeah, so these are the Datastream mnemonics. These are the names. These are the issue dates, the terms, the redemption values, coupons, coupon types, last redemption dates, price at issue. So that's an extra one that I've added myself within the Python function I've created. And the yield to maturity, which is computed with this price at issue. I guess it should be yield to maturity. Yeah, no, there's no other term for it. Okay, once we've got this kind of data, it'd be interesting to look at it in a graph. So don't worry too much about, there's quite a lot of code there, but most of the code is for the vertical lines as opposed to the actual graph itself. So if I scroll down, it did tell me if there's too much background noise. There's a car going through at the moment in the background. This is the plot of the data we've just seen above of US 5-year Treasury notes. And these are yield to maturities in blue and the price at issue in black. And something that when I plotted this, that caught my eye was the fact that, okay, so here, if you look at these 4 dots, these 4 data points, as price goes down, yield goes up, which is exactly what we expect. Fine. This happens here as well. It happens all the way up until here. And here you notice that as yield to maturity goes up, somehow, look at this, the price goes up. Now that's technically impossible. There should be no way for which an increase in price means an increase in yield to maturity. They are mathematically invertly related. And I figured out that the reason why that was is because we're not looking at bonds that are actually comparable because they have different coupon prices. And that's what the vertical lines are. So I've here, if I scroll back up, there's going to be, there you go. You see all of this here. All of that is only there to add, oh no, this is only there to add the vertical lines in order for you to be able to see which coupons have the same, which bonds have the same coupon prices. So here, all of these have the same coupon prices. All of these have the same coupon prices. All of these do as well, but this one here and this one here, they don't have the same coupon as anyone else. So that's quite interesting. You can then see which bonds you can compare to which. Scrolling down, we're going to be looking into bootstrapping. Now, this far we've been looking at the yield to maturity of coupon paying bonds. And the way you do this is that you look at the cash flow of the bond. So if I scroll back up, scroll up, scroll up, there it is. You have the summation of all the coupon payments and the face value, and then you take away the actual price, the market price at the moment, and you get your net present value, your fair value at the moment. And from there, you compute your yield to maturity. But here, you've taken into account all the coupon prices. You can't compare that bond to a zero coupon bond because a zero coupon bond does not pay coupons. So all of these are not comparable with zero coupon bonds. What would be really interesting is if we were able to equate this coupon paying bond to a zero coupon paying bond. If we were able to do this, then we'd have nothing but comparable data. The yield to maturities, the prices, all of these things should be comparable. So if I scroll back down, what we're going to be doing is exactly that. We're going to try and extrapolate a zero coupon bond equivalent yield to maturity. There it is. And that's what we're trying to do here. And then I remind everyone of what a net present value calculation is, with a specific bond of a specific issue date and a specific frequency, accounting compounding frequency, annual compounding frequency. And this is what it is. And notice here that we have SR as opposed to YTM for yield to maturity. Here we have SR. The reason is if you are bootstrapping a zero coupon equivalent yield to maturity, if you're bootstrapping that yield to maturity, you call that yield to maturity, you call it a spot rate. The reason for the change in lingo is to explain very explicitly that you are looking at a fictitious yield to maturity. It's not a real one that you can actually trade with. It's a spot rate. It's one that you have to convert from a coupon paying bond to a zero coupon paying bond. However, if you were to be okay with taking coupons, right, and reinvesting them the way you should, then it is equivalent. It is equivalent to take the coupon paying bond, reinvest the coupons up to maturity, and just buying a zero coupon bond at that rate at that time. And that's why we do this. This is why we do this exercise, in order to have then yield curves and things as such, where all the yield to maturities are comparable to each other. And I just talk about what each term within this equation means right here. And then I change the whole equation so that we end up with this thing here, right here. So this is the spot rate that we're looking for, that we're trying to compute. And we're computing this spot rate with the rest of the data that we've got up to that day that we're looking for. You can only compute a spot rate for the last time period of your cash flow. So if I'm looking at, let's say, a 3-year to maturity bonds that I have in my hands, I can only compute the spot rate for that last half year, the last 6 months of that bond. If I wanted to compute ones beforehand, I would have to use data from elsewhere. I'd have to use data from other bonds in the market in order to try and then figure out what the spot rate is every 6 months. Notice something here. If I zoom in, if I scroll back up, actually, you'll be able to see it better, I guess. Here it says SR for the spot rate, similar to the yield to maturity rate. It says bond, and bond underscore T. Now T is for the issue of the bond. So this is the spot rate for a specific bond. Okay, that's simple enough. However, notice here this is comma tau. Now it's really hard to see, so I'm going to zoom in even some more, just that one time so that you can see this here. It says comma tau. Now tau is just a Greek version of T. I've just used it to make it different from T. But notice what this implies. It implies that our spot rate changes for every time period that we're looking at in our cash flow. So every 6 months, if we are compounding every 6 months, this spot rate will be different. Now, they can be equal to each other. It might be the case that just out of the blue, it happens to be that the spot rate is the same, but it's not necessarily the same is the point. And you have to compute them at each iteration. So the first 6 months, the second 6 months, 1 year, 1.5 years, 2 years, 2.5 years, and you have to go on this way for each spot rate. So you need quite a lot of data, really. You need quite a lot of bond data, bond prices, and coupon rates in order to figure out each spot rate. I did a little, it's quite simple to do this in Python. This is the Python function for it. And if we look there, we have on-the-run sovereign bonds. Now, on-the-run sovereign bonds are bonds that have just been issued. So the US government, US Treasury might just sell one right now, today, and I can buy them today until they run out. And that's fine. Those are called on-the-run sovereign bonds. And they're the simplest ones to deal with, because if you deal only with the latest ones that have been issued, then all the bonds have the same issue day, and that's easy to deal with. You're not dealing with ones that have different issue days, and when you're trying to calculate, okay, how many years is there to maturity again? I don't know. You're not dealing with that. So these are the on-the-run sovereign bonds. And if we were to do some math with it, so we're looking at the issue day, the terms, the redemption value, coupon rates, blah, blah, price at issue, and the yield to maturity. I just did an extra one for cash flow here. There's no actual need for it just yet. If we look at the yield to maturity, we get our yield to maturity. Oh, that's great. Scroll down. This is our yield to maturity. Now, I don't know if you've seen yield curves before, but there's only 4 data points here, and that's very, very little. That's not enough to go out and then trade on. I can't just think, oh, okay, looking at this is an exponential growth, or not growth, but it's an exponential graph, and I expect yield to be higher later, so maybe I should buy a yield with, a bond with a longer maturity because they have a better yield. You can go ahead and do this, but there's so few dates here, there's so few data points, that you can't buy many bonds according to this. You can buy one that matures in 5 years, 5.5 years, 5 years. You can buy one that matures in 7 years. Is that it? Oh, actually, yeah, there you go. 5 years, 7 years, 2 years, and 6 months, and nothing else, nothing in between. Now that's pretty crazy. You should be able to buy something in between. What if I want one that matures in 1 year? That should not be so difficult to do. It happens to be that on-the-run bonds, so the ones that have just been issued just now by the Treasury, they don't issue bonds, or maybe they do. They do issue bonds of all maturities, but you can't buy them, and you have to buy them from the secondary market, maybe investment banks or huge wealth firms, and they don't sell them. They don't sell, for example, on that specific day at the end of July 2020, they did not sell, according to Datastream, bonds that had a 1-year maturity rate. They just didn't if they were on their own bonds. So as a result, if you really want to kind of fulfill that yield curve, there are several ways. A lot of people try to interpolate them. So they say, okay, so what would be the theoretical yield of so how much is this? 2 years, isn't it? This is 5 years. So let's say 4. A 4-year to maturity, year to maturity bond should fall around there, right? And I can see a straight line in between the 2 points, and a straight line interpolation would say, okay, it's close to 0.02, 0.018. Why not? And it'll say, okay, straight line interpolation is mathematically very easy to do. You'll get a yield. The trouble with this is that if I was to say, okay, now I'm happy with the yield I found according to my interpolation, yeah, I'm very happy with that interpolated yield. And then I go to my portfolio manager or whoever else, and I'm saying, okay, look, I'm trying to hedge for some risk that I've just taken. I've bought I don't know, a stock that's quite volatile, and I'd like to hedge. I'd like something that's not too risky in order to make sure that if things go wrong, there is still some cash flow coming in. If you go to your portfolio managers and say that, they'll say, okay, which ones do you want? Did you find one? I said, yes, I found one that matures in 3 or 4 years with this yield to maturity. They'll laugh at you because they'll say, well, I can't do that. There is literally no bonds sold today with this yield because you've just interpolated a theoretical one in between the two. Now, there's several things you could do. You could buy 2 of them and then sell them at different times. And there's also other things you could actually do. This other markets such as futures markets, and I'm going to talk about that later, where you can actually do this. But if you were to actually be just one person, maybe you're a single wealth advisor, and you're trying to hedge, it would be extremely difficult without maybe an entire team of people hedging for entire strategies of different teams. The likes of investment banks, the ones that are actually buying the bonds to start with. It's very difficult to do that. So what I wanted to look at was how would an economic agent do this on their own? And that's when you then look not only at on the run securities, but off the run ones as well. It gets a bit more confusing as well, because if you were to have too few data points, and that's a problem of liquidity, you can't compute spot rates. You can't actually get equivalent, zero coupon equivalent yield to maturities. It's impossible. You don't have enough data points. So you might interpolate yield to maturities and then compute spot rates from that, but you're making so many assumptions by the time you're actually doing this, that your yield to maturity is so theoretical that once you try to implement it, apply it to your trading strategy, it's probably going to be wildly different. And I give an example right here. It's a very long example about exactly how our strategy fails when you have a liquidity issue. And finally, after 38 minutes of talking, I get to the meat of the subject. This is my code. This is where I've kind of finished with my code now, and I'm coding some more. So from now on, I'm going to talk about new code. I don't know where this is going to go. I might make some mistakes. I might try and correct them. Tell me if you find any. If you think I'm doing some things that are incorrect, by all means, this is very interesting to look at. Yes, someone's just asked if it's possible to get the notebook in order to follow up. This specific notebook is going to be on the article once it's published, so it's not there yet. Although now that you mentioned it, I should try and get it. Yeah, why not? I'm going to put it on GitHub. So if I show you, we have a GitHub repository there you go. So that's just me. But here there is one for Refinitiv. So if you go on github.com/refinitiv-api-samples, I'm going to put the codebook right there for you. So let me just do that. So I'm going to put it next door because I've on another screen because I'm going to have to go through all my files. Let me do that now for you. I forgot where I've put it. Let's have a look. So by the way, I'm using JupyterLab. I don't know if you're aware of it. JupyterLab is just a Python IDE. It's just an environment that you can use, a GUI that you can use to see your environment. And in there, there's you can see here the folders and things as such. I forgot which folder I put it in. There we go. This is on risk-free rates and excess returns from coupon-paying bonds. Where is that? It's in projects. So what I'm going to do is I'm just going to put the notebook that you're seeing right now, I'm going to put it on the Refinitiv GitHub page, but I'm going to put it specifically, there you go, in a repo that already exists. Reason being that I'm not finished with it yet, so I'd rather do that if I can find a way to do it. Indeed, if I can find a way to do it. There you go, upload file. There it is. By the way, I didn't show you, but I've got a system if you're interested. You know, how to code in general, how to code these things. I have a system whereby I keep all of my backups, all of my old code. The reason I keep all of them is because there might be a technique I used at the start, right, in the first, second, or third version. And later on, I figure out that actually the technique, and then I kind of overwrite my technique. Maybe I use another technique. Let's go. Instead of straight line interpolation, I try to use cubic interpolation, which is a bit more complex. Let's say I do this, but then maybe on the 14th file, I realize that there's actually an issue with the cubic interpolation, and if I was to delete everything apart from the previous file, I would have lost the straight line interpolation code that I've written 14 versions ago. So I keep everything until I'm finished with my code, and when I'm finished with my code, I put everything in an archive. And if I was to ever run out of memory, I would just go in all my archives and delete everything, because I know that these are just old code. I don't necessarily need them. I'd rather have it and not need it than the other way around. Anyway, long story short, I've put this notebook in here. It's specifically in this article repo, called Computing Risk-Free Rates and Excess Returns from, and there it says 0 coupon bonds, because that's the first part. This specific one, where we look at 0 risk-free rates and excess returns from coupon-paying bonds, I consider this to be part 1.5 really, because it's not finished. So it's in this repo. I hope this answers your question. It was Longrund 1950. All right. So you can go in there and have a look and follow along. Although you'll need your own Datastream credentials. I think that's pretty obvious to get the data you need to follow up. All right. Spoke quite a lot. I'm running out of breath. So I'm just going to be coding now. I do tend to talk as I code. And do let me know if you've got any questions. I can see there's a chat going on. All right, so what I've done this here. Yes, so if I can show you. This is so I've got my off the run sovereign bonds. So this file we were using on the run sovereign bonds, which were the very last ones, just issued by the Treasury, which made the mathematics easy, but then we figured out it actually made it impossible because of a liquidity issue. Now I'm using off the run sovereign bonds. The difference between the two in that off the run sovereign bonds were issued before the latest wave of issues. And as a result, their maturities change with time. So here, for example, we only used US Treasury notes issued at the end of July 2020. But if I was to have used a bond issued at the end of July 2019, and let's say it had a 2 years term, a year later, so at the time when I'm taking this snapshot, I'm imagining I am an economic agent trying to invest in all of this. I'm trying to get this snapshot at the end of July 2020 on the 31st. If I was to then try and figure out a way to get a 1 year to maturity, I've already got 1 year. No, I don't. A 1 year to maturity bond on that day, I will have to then go back, find a bond that was issued last year, so a year ago, with a maturity of 2 years. Reason being, obviously, maturity of 2 years, 1 year has gone by, therefore there's only 1 year left. So the year to maturity today is 1. And as a result, I'll be able to get something in between those 2 points, you see. I'll be able to get a yield to maturity in the middle there in order to not have to assume a straight line interpolation, a cubic interpolation, or anything at all. Actually, it's just going to be the market price. All right. By the way, I just realized I didn't say my name. It's Jonathan Legrand. That's why I've got a J on my mug. All right. So that's what I'm doing here. I've got my off the run coupon bonds. You see, I'm getting my coupon. So that's underscore C for coupon. Underscore because it's ephemeral. I put underscores. I think it's actually quite something that's done in general. If you're using ephemeral Python objects, which means that it's a Python object that's going to, you don't care if it disappears, you don't care if it's deleted. After you do your math with it, you don't care if it's deleted. Often people don't delete them because it's just, why would you write a piece of code to delete something that has so little memory? I'm talking about a floating point number that only has maybe 5 or 4 decimal points. So it's very little memory that I'm using here. So I'm not going to waste my time deleting it. So here I've got my coupon. It's off the run data frame. So it's a data frame full of data of bonds that are off the runs, not on the run. I'm looking at the redemption value, which is $100, and the coupon percentage. That's why it's divided by 100. So it's giving to you in percentage. So 0.25 is actually 0.25%. So you have to divide it by 100 to get the absolute ratio, and then times it by your face value to get your coupon. So that's my coupon, and then I figure out my cash flow. So I add the coupon to whatever the face value is every 6 months if it matures. If it doesn't, it's just a coupon. And that's what it does right here. So I've got my CF2 is just my my list of cash flows, and I run through this for every bond. And this is what I've got here. All right, so that's my YC stands for yield curve. And I'm appending my yield curve data frame with these off-on data frames. So off-on is both off the run and on the run bonds that I've meshed together. Can't you see? There you go. There you go. Here it is. YCDF append off run DF. So I've added the off the run DF, and now I think that's a mistake. Surely that's a mistake. I shouldn't have to do that twice. Yeah. Let's take that off. By the way, I've pressed Control / to comment out a piece of code. And to comment out, I just have to put a hashtag in front. Hashtag in front makes sure that even though it's written in the code, so you can actually see it with your human eyes, the computer's going to ignore it. It's not going to run it. It doesn't even know what's in there. Okay, so off on, then what I've done is I've added the price of my bond at a specific day. The reason is I'm looking at off-the-run, certain off-the-run bonds that were issued a year, 2 years, 3 years ago, however many years ago. But I'm interested in this snapshot of an economic agent investing today. And today happens to be the 31st of July. And so I want to know the price today. And that's what I'm doing here. I've got my price on that specific day. So you see that I've got my get data from Datastream, and the start date and the end date is the same. So I'm just looking at that one day. Field X means default. So the default here is just the price. I want a daily data. I want the data on that one day. And then I just get the value. That's what this is there for. Instead of gathering a whole data frame of information just for one number, I do dot value and then these two things to specify which value among the data frame I want. And I do it for each one of my, you see, for I in my list. That's what I've done here. And I've added this to my data frame, the on-off, off-on data frame. And then I've implied the yield to maturity from it with my yield to maturity solver that I've spoken about above with my that Newton thing. Once this is done, then we sort by the values of redemption days. Yes, there you go. So I just sort out the values in terms of when they redeem. Yes, because when they redeem is basically when they mature. And that's the time I'm interested in. And then I plot that data. And you can see that the data is very, very strange. So the first time we did it, we had this data point here. And then we had that data point there. And then if I'm not correct, we had this one right here, 2025, or maybe this one, July 2025. And then that last one. And we saw that it was kind of an exponential rise, and we were happy with this. However, when you start to introduce off-the-run bonds, you start to see a very interesting dynamic. These spikes are very strange. I don't expect those. And the fact that I don't expect them mean that I might have done an error. And that's when coding becomes interesting. I want to check that these are correct. And the way in which I can check them is just to do the math I've already done, but do it in reverse. And it should give me 0 at the end. So that's what I'm doing right here. So here, what do I have? Ignore this. This is just code from before. I've copied and pasted it so that I don't have to scroll up and down all the time. So what I'm doing here is I'm just saying for I, within the range of my whole data frame, I want the face value for each one of the rows. I want the coupon, which is the face value times the coupon divided by 100. Brilliant. I'm going to keep the accounting frequency the same, just 0.5, which is semi-annual, which is kind of the basic that everyone does. P underscore P is going to be the price, specifically the price at the time where our economic agent is acting. What else is there in here? Oh, this is interesting. Okay, actually, I want to have to show you this because I'm printing it off, and I've already done it here. So what that does here, it's a little technique to round up. So I'm looking at the date when the specific bond I'm looking at is issued. I'm looking at the date when it's meant to mature, and I'm calculating the difference between the two. And then the difference between the two is the redemption. The term. So if it's a 2-year to maturity bond at time of issue, this should give me 2. If it's a 5-year one, it should give me 5. Trouble is, I've divided by 360, and there isn't 360 days per year necessarily. On average, there is maybe, but not necessarily. So I have to do this little trick here, where I multiply it by 2, and then I round it up, and then I divide it by 2. When you do this, it just rounds up. It gives you like a ceiling. It's not exactly the same as a ceiling, so don't use ceiling because that won't necessarily work. But just to make sure that it worked, I ran specifically this, and you can see below that it worked. So we've got our first, actually this one is on the run maturity bond, so that's 0.5, and then we've got our first off the run one, which is 1 year, then 1.5 year, then 2, 2.5, 3. Yeah, I think so. Yeah, 3, 3.5, 4, 4.5, and then this is on the run again, 5. 5.5, 6, 6.5, and 7, which is on the run again. So it works. This is exactly the kind of maturities that I wanted. The reason I've done this instead of just writing that down is I want it to be generalized so that you can actually just put in whatever bonds you are interested in, and it would spit out what you're looking for. Okay, so I've got all this. This is my yield to maturity. There you go. So this is where I think there might have been something that's gone wrong. So this is my yield to maturity solver. It's my function, and I'm inputting all of this data. So I'm confident now that all this data above is correct because all of it comes from my data frame from Datastream. So it's not I did not calculate it. I did not. It's not even calculated actually. It's just data, raw data. And this is the only thing that I've calculated, and I've just checked below to make sure that it's correct. So it's correct. And so this yield to maturity should work. But if it doesn't, then I expect this not to work. So here, what I'm doing is I'm reversing the yield to maturity calculation I was talking about. I'm inputting the solver into my equation, and it should give out 0 or something very, very close to 0. If it's not close to 0, it means that my yield to maturity solving Python function does not work. So what do we have here? We have our price. We're dividing it by, what's this? We're dividing it by 1 plus, this is the frequency, the yield to maturity, which we've calculated. Aha, here it says to the power of 10. That won't work. What am I looking for here? Underscore M, pretty sure. Yeah, underscore M is going to be the years to maturity at time of purchase. And here I've used P, underscore P, which is the purchase price. So M and P are comparable. And so is yield to maturity, because yield to maturity uses face value. That's fine. Where's the price? There you go. There you go. It uses the purchase price as price, which is good. So they're comparable. And then I'm summing up all of the coupons. so what's a coupon? A coupon is _c, as calculated above. 1 plus our frequency, so which underscore. So that's what this is. This is what I've copied and pasted from above because I can't remember it by heart. So this is our accounting annual compounding frequency. Our yield to maturity to the power of I. So we're doing this for every summand within our summation of our cash flow, which ranges from 1, not 0. You don't start at 0, you start at 1. But then we don't want to go to 11. So remember that, I don't know if you know, range is a Python function that is exclusive with regard to its upper limit. So when it says range 1, 11, we're not going to go from 0 to 11. We don't go 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We actually stop at 10. We don't do 11. It's exclusive with regards to its upper limit. But here it was 11 because we were looking at a 5-year term bond. So 5-year, we multiplied it by 2, which is to say we divided by the compounding frequency. So whatever it is we've multiplied it by 2, which is the same as dividing by 0.5, and that's what this is. ACF is the semi-annual frequency, which is 0.5. And this was the maturity, surely. Yeah. So that's what it is. So we're going to go from 1 all the way to this. Oh, I've got an issue with this, though, because is this always going to be a whole number? I think it is. But Python, unfortunately, might, because I'm dividing, Python might automatically change that to a floating point number. I'm not going to get too much into the details, but floating point numbers you can't go from, or you can't range through. So you can't, for example, go from 1 to 7.2 or 1 to 2.2. You can do 1, 2. There's no 2.2. So you have to go and round it up into an integer. And that's what that does. So I'm putting an integer and then I'm doing minus the price. So let's go P. Wait, will that work? Yeah, no. I mean, that will work, but I've done it wrong. At the start, I said _p, but that's the face value, actually. Yep. Face value. So it's a face value that I'm discounting. Yeah, that's right. For the number of maturity days I've got. So you see, this is the kind of mental trickery you have to go through in order to, and this is me just checking my code. All right, so this is what I've got, and this is 0. So I expect this to be equal to 0. It might be close to 0, it might not be exactly 0, but I want it to be close to 0. So here at the bottom, I'm going to print out all the details that I'm looking for. I'm looking for the years to maturity to make sure that I've got the right one, to make sure that my calculation works. The actual years to maturity themselves. So the yield to maturity specifically that I've calculated, just in case I want to do some manual stuff afterwards. And then I want to print out 0. So error. All right, so what this does is it just prints all of this for you through the iteration. So I'm iterating for I in the range, going through all of this. There we go. So that's really bad. Isn't that really bad? I've got yield to maturity for my maturity. So my maturities are right. No, yep. My maturities are correct. But this is definitely not. That is a woeful error. I expect this to be 0, close to 0. Now this is an interesting one because when we did it above, we had a different error, a very small error, which is expected. It was times 10 to the minus 14. So if I search for minus 14, if I give it some time to think about it, no, too long. Ooh, I broke everything. There you go. I'm going to save it just in case it breaks again on me. It might be the stream that's slowing it down, but there you go. Minus 14. Maybe I'm not remembering it correctly. Let's have a look. Let's physically go up. There it is. There it is. Should have picked it up. So yeah, that's a very small error. However, this is... Oh, this is not the right one, is it? This is a 5-year to maturity issued. Is that issued on the same day? Yeah, it is. But I used, if I show you, if I go back up, the way in which I figured out this error specifically is through my function. I created this yield to maturity function solver. And it gave me my error here. And it returns the error if you're asking for it. Okay, just in case. What have I done wrong? I've done something wrong for sure. Just in case, for some reason it decided to. What's happened here? Crazy stuff's happened. Oh, it's put it in Markdown. Ah, indeed, crazy indeed. Remove that, remove that. Yeah, that should work. Let's run this again. Yeah, same dreadful errors coming up. It could be an issue with the Newton iterator, but I don't think so. Aha. Yes, this should not be M. This should be M divided by the frequency that we're looking for. Because we're doing it semi-annually. We're not doing it annually. Bit better. It's a little bit better. So this one is great, but it's a 0 coupon bond, so it's always going to be 0. But this one, however, is not only is it not a 0 coupon bond, but it's a off-the-run one. I'm still not happy. 0.0006 error is not great when your yield to maturity is 0.001. So that's actually rather dreadful. But this one is even worse. And look at that. It's awful. So what's happened? What's wrong? Let's try and get the error as well. So yield to maturity, comma, error, error equals true. And let's say that the let's just call it 0, exactly like I've called it myself. Let's call the other one error, comma, error. Run this. Look at this. This is very, very different. Okay, so the error I assumed is not the error I'm getting here. So I've done a mistake either during that when I made the yield to maturity function, or right now when I did this calculation right here. So let's check this one first. What am I looking at here? What am I looking at here? It's a list. I've got my coupon on the left, dividing it by 1 plus Yep. That should be fine. This yield to maturity, I'm dividing it by 2 because it's straight line interpolation. It always straight line interpolation when it's inter-compounding period. Our compounding period here is semi-yearly. So if it's if it's inter-year, surely. Yes, because that's how yield to maturities are given. Yield to maturities are given annually, and they're always assumed to be straight line interpolated in between the two. That's just a standard in order to be able to just do the math easily. So what we've got here is our yield to maturity divided by 2. To make things easier, let's have a look at our equation and let's put it side by side. There it is. Okay, take a snapshot up. Up. Just gonna keep this in the corner. Scroll back down. Hop. There it is. All right, so, oh, you might not be able to see it. It might be on the side. Stream preview. Have a quick look. Yeah, you can't see it. Up. Better. Right, so what we're looking at here, we've got the sum, we've got the coupon. Coupon is right there. It's coupon. Ah, haha, you see, it was multiplied by the annual compounding frequency. Why would it be multiplied? Because coupons are given on an annual basis, obviously. So let's check that I did it correctly the first time. I'm going to copy and paste it because I'm not going to go scrolling up and down all the time. Copy this, and then I'm going to use another IDE such as, yeah, Sublime. Oh, there it is. I was already trying to look into this before. So I want to make sure that I'm multiplying it by the, there it is. You see, frequency of accounting compounding frequency multiplied by C. So you see, I've done it correctly here. Yep. I didn't put this in parentheses, so maybe that's going to change something. Oh, it's interesting I did +1. Ah, of course, because it is, as I said, it is exclusive with respect to its upper limit. So I did all this 1 all the way to this, but you have to add 1. Yep. So I'm not starting at 0, I'm starting at 1. So I'm going to do +1 at the end. And then here, see how simple it is to make mistakes in these? It's just one line, one little thing. I've got my frequency, accounting compounding frequency. And then what am I doing with this? I'm multiplying it by C. Yeah. Okay, let's have a quick try. Oh yeah, it's not going to like this. There. It's not going to like this. It's better, but somehow they're not the same. Again, so you see, this is the kind of stuff you have to do when you're coding all the time. Just verify with it with yourself, because this is a function I've created myself. And then afterwards, I also check with other sources. Well, that's what I've done at the start with my yield to maturity, but I haven't checked my error, so that's what I'm doing now. If you can verify your code with real data, always do it. So that's what I'm doing here. What's wrong? Oh, that error is awful. 9. Oh, that's the error given by the formula. Oh no, times 10 to the 15. There you go. Minus 15. Minus 9's not good. Although it's 1. So maybe 10, 11, maybe 12. Not great. Yeah, 11. Okay, I guess 10 is not too bad. There is still a discrepancy. See 1.33 to 1.42. 9 and then 1. I don't think it's an iteration thing. It shouldn't be. It should be the same every single time. Because I'm not using much CPU power at all. So I must be doing something differently. I'm going to put my code, this one, on my other screen to be able to compare the two. Hop. So here I have my face value divided by all of this. frequency, yes, that's correct. To the power of. No, that should be correct, yeah. Yep. Okay. The brackets seem correct. There's a lot of them, but they all seem correct. 1 plus, so I'm doing the power of everything here, which is correct. Again, that's for that bracket, and that's for that bracket. And then I'm doing the sum from 1 to this. Yep. What am I doing a sum of? I'm doing a sum of my coupon payment made. Let's have a look at the equation. 1 plus frequency times yield to maturity to the power of tau. Tau is your I, changes every time, that makes sense. So what have I done in my other equation? Face value. So this is the equation I'm looking at. This is the code I'm looking at. I've got my face value. 1 plus face value, 1 plus frequency times yield to maturity. The 1 plus blah 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 is all to the power of m over f. Makes sense. I've done the minus p in the middle. Doesn't matter where you put it. And I've got my sum, frequency times c, which I remember is what we've done. 1 plus this. That's what I've done, isn't it? Yep. This is so strange. Should be the same. By the way, I'm going to just stop at past. I was going to stop on the hour, but you know, we're going. We're still going. Yield to maturity equation. Face value. I've got my face value of my coupon. If you can see it on your end, if you see the discrepancy between the two codes, do let me know. Frequency times c, which is correct, and that's what we done last time. 1 plus my frequency, all in brackets, to the power of I, for I in range. Exactly like last time. This makes no sense. There's something wrong here. Oh, have I made a mistake with the yield to maturity I'm using? Here, yield to maturity. No, that's not right. There's something wrong. I'm tempted to let it be, saying, okay, you know, it's really close. And it's also very small. And that's the aim. The aim is for it to be small. But I don't care. This is really bugging me. It could be the Newton thing. It shouldn't be. The reason why it shouldn't be, right? I'll give you an example. Is if the issue was to do with how the the Newton process iterated through our code, then the results should be slightly different every time. Not much, but slightly, especially when we're looking at things times 10 to the minus 14. I'd expect, for example, this one on the right here to be different every time, maybe by just one digit. So what I'm going to do is I'm going to run it again and then check against that one digit, and you're going to see that it's the same one. It's because it's iterating through the same stuff every time, and it happens to be that I'm not using anywhere near enough computing power so that my computer gives me a different result. So you see here, -1, 4, 2, 10, 54, 71, 52, 0, 200, 4. Yeah, no, same. The one below is the same as well. Yep. There was the one below that. 6. Yep, same. Below that, last one. Just a sanity check. 421709. Yep, 43040. 41. Yeah, they're all the same. Not only are they all the same on the right, but they're all the same on the left. Yes, they are. Yeah. So yeah, no, it's not an iteration issue. It is me. It's an error in my code. Reason I'm so bothered by this is, well, look, I mean, it's times 10 to the minus 14, but when you start to compound stuff, and that's what we're doing here, you're looking at compounding cash flows, it can build up, and that's not something you want. So we're not interested in this. What are we? Aha, maybe. That's the problem. Because look, this one here, no, it's not the same. No, it's not the same. 2.5, 3, 3.5. So that's weird. This one's the same. No. Yeah. That makes no sense. 3.5. It's not an on the run bond, although that wouldn't, I can't think of a way that would change anything. So now I'm thinking, how can I test all of this? I guess. No, that's silly. So you see the error gives the return of that equation that is defined within the defined function. It's a bit of a mess, but I use it twice, so I might as well define it. Twice, 3 times, I think. No, twice. Yeah. What could possibly go wrong here? Maturity and error. Ooh, I see it actually. Okay, let's try something else. Yeah. What if instead of doing this, we do this? Should it be? This is so bothering. Okay, so I've got my face value. I need the sum. I don't only need the sum, I also need the price and everything else. Hop. What have I done? Yeah, there we go. Sum minus p. Oh, okay, I see. These are not the same. Oh, wait. Was it just a typo? Most often it is, so I would not be surprised. Maybe I'm getting tired. Nope. I thought maybe I forgot the underscore. So let's check all of the underscores. Yes. Is that underscore? Yeah. Did I forget it anywhere else? Nope. Nope. From date. Haha. What is from? Yeah, no, from date is from before. From date will be fine. No, it won't be. From date here does not change, whereby we are looking at. Oh no, it will be. It will be. From date is only just helping us calculate the maturity, years to maturity, which is correct here. I don't know what that is. Shouldn't be there. Let me run everything again. Oh, this is so strange. So very strange. Okay, I've commented this out, run everything. So let's clear the kernel and run. Go on. There you go. Run all above. Oh, there shouldn't be an error. Oh, there is an error. There's an error somewhere. Oh yeah, the yield to maturity here is meant to be the yield to maturity up. Boom, and boom. Yep. Right, let's run everything from there all the way to where we were. Yep. That's it. Run. Another error. Probably in the same cell. No. What I must have done is I must have defined calendar below. Not done it on purpose. Define calendar. 1, 2, 3. Yeah. That's exactly what I've done. There it is. Found it. Import calendar. Up. Let's find the cell it's in and let's import it in there. Calendar. Oh, I should probably do it at the top actually. Let's do it here. Run that. Remove this. It's done it twice. Run the cell just to make sure there's not another error. And it works fine. Dandy. Boom, boom. Let's have a look at the figure. What's the error now? For crying out loud. Ah, yes, I know exactly why. I did not run my old cell again. So let's restart the kernel. Yes. And you should let me save this as a new thing. So you see, that's why I'm saving it as new, because I've done so many changes that I might want to go back to old versions. See what I found in the past. Okay, so scroll down. It's quite good actually. It's debugging lessons for everyone, and run until cell. Run all above selected cell. By the way, if you have any theories as to what I might have done wrong, if you've spotted a typo or something as such, do let me know. But what I've done here is I've changed my yield to maturity function. Which one? Where is it? This one. I've changed it. So now I expect it to be the same. Well, I always expected it to be the same, but it wasn't always the same. Yeah, it's not the same again. That's so strange. It's close. Close, but no cigar. Indeed. Indeed. Oh, that one is so close. Okay, I think I'm going to stop it now because maybe it's not very productive for you to be watching me debug. Maybe I'll find the result between now and next time. That is very strange, isn't it? I have done the same here, haven't I? That's what I need to check. I need to copy and paste this copy that, go to the bottom, paste it here, boom, and then look at the difference in that and hop, that. It's the difference between those two cells. Obviously, the underscore, it's an obvious one, so I need to change. Actually, let's do that now. Hop, underscore, underscore. It's not up because we're just giving the yield to maturity given by a yield to maturity solver right there. Underscore M, underscore F, underscore P. Underscores everywhere. You get an underscore, and you get an underscore, and you get an underscore. But I do not want OP. You're not OP. You're not so overpowered. Right, underscore, and you get an underscore. How is that not the same? Shouldn't they look the same as well? Like they should be exactly the same. So I've got minus underscore P here, which I've just got at the end here. So if I move that there, oh my god, that's going to be the difference, isn't it? So where's that difference? Boom, boom. Ah, I've just got no space. That's going to be it. So what's going to happen is it's going to be a rounding. It's going to be something to do with Python rounding whilst it's doing the calculation. Oh, I can't believe that. And that is the same. Figured it out. We figured it out. Okay. It's the underscore P. So it should not be an issue. It should not have changed anything, but it did because what it's done is it only has, what is it? What is the, so if I do type, you'll see the type of data we're looking for, that we're looking at. So type, no, TIP type. There you go. Hop. And then if I put bracket in there, it's a float. NumPy.float 64. That's really interesting because what that means is that we're looking at a floating point number. So that's a number that has decimals in them, which we expect. And it says 64. What that means is that we're using 64 bits to encode that number inside our memory. And that's quite a lot. As a matter of fact, that's the maximum I can do on my machine. I don't think I've got 128-bit machine, and you could artificially put 128, but I'm not going to go into that well, that never-ending possibility. So that means we're looking at very, very precise data. So I'm surprised that with such precise data, we're still getting some, not rounding errors. I mean, there are rounding errors, but they're so small. We're talking times 10 to the minus 14. So now I've put the P at the end, you see here. And if I run this, we're going to get a different result. Well, somewhat, quite different. Again, times 10 to the minus 14, so not that different, but still. So type, hop, end, close. And now I'm looking at the type of this, and I'm expecting the same again. You see, so if I put the P at the end, it doesn't change the type of data we're looking at. But 64 bits seems to be too little for the very start of our equation. Even just there, we haven't even done the summation yet. And that seems to also already occupy 64 bits and change according to where we put our P. As a matter of fact, the P is quite big. It's quite a large number, like 200 and something, 100 and something. And you're comparing it to numbers like 0.4 or whatever. So maybe that's the issue. I wouldn't be surprised if that was the issue, actually. There might be a way around it. I'm sure there's ways around it. I might look into making this more precise, but it is rather accurate. Whether or not it's precise, it seems to be quite accurate. So that's the interesting bit. You see, I was looking for accuracy. I wanted to make sure that my yield to maturities were correct. And you know what? It is quite correct. Yeah, it's not super precise. We are times 10 to the minus 14 off, and that's 13 zeros, right? And we're looking at a chart with only 2 zeros. So we're like by a factor of how many? 1,000, million, billion. We're less than a billionth off of these, less than a billionth. So we're pretty accurate, somewhat precise. So no, that's probably it then. That seems to be it. This is the yield to maturity from secondary markets for your treasury bonds that we're looking at, both on and off run. So that's really interesting. So this is correct. What this means is that we have quite a lot of volatility then. So granted, the volatility seems to be between the difference in on and off the run data. Tell me if there's too much background noise, by the way. There's someone playing music outside. So this is very, very interesting. That means that if there's so much volatility, there is potential for someone to then look at other bonds that were issued at different times but mature at the same time. And that's what's important, really. If they mature at the same time, that's what you're interested in. And they might have different yields when you're buying them. So you may have one that's really, really high. So one that matures in 1 year and sells for, let's say, £100, and one that matures in 1 year and sells at £99. If that's true, then you have a pound difference and you've got an arbitrage. I guess that the reason why we have such volatility still in the market, regardless of the fact that people would buy, normally they would snatch this arbitrage opportunity within a click of a finger really, really quickly. I mean, they've got machines that search for such arbitrage opportunities all the time. I'm guessing the reason why it hasn't been done here is because of trade cost. That's usually the answer. Although that is pretty monumental, isn't it? Look at that. Boom, boom, boom. I'm guessing maybe it's correct. Maybe in some strange way, everyone's expecting the vaccine rollout to go extremely well. Maybe not worldwide, but we're looking at the US here. Maybe in the US in 2022, specifically on that on that day, at the end of 2021, and then at the end of mid 2022, they expect everything to go back to normal, and maybe some kind of war in 2023 because it goes back up. I have no idea, or vice versa. Actually, vice versa. They expect things to maybe open up, maybe the waves, maybe COVID waves. They expect lockdowns. I have no idea. And then less and less, and you can see that it's actually flatten at the end. But you'd expect a flattening at the end anyway, but just not such volatility. That's just so interesting. Anyway, that's the lesson for today. What we've done is that we've encoded yield to maturities into a yield curve that is actually realistic. It's looking at an agent that will go into the market, in the secondary market, maybe with Goldman Sachs, JP Morgan, whoever is selling. Actually, you can have a look at who sells these with the code I've showed you. So if I scroll up, at some point I talk about the market. Scroll, 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 scroll. Continue, scroll, scroll, scroll. Some more. It was quite up high in the code. There we go. There it is. Here I say exchange, and this is the exchange where you can go and you can check which exchange each code means, because this is just a mnemonic, and you can click on that on code, and in there you'll see the code in question. So AA is this, whatever this is. AC is Ghana. So you have all of your codes right here. If you're interested, you can add some code to it to make sure that it is within your exchange that you're interested in. Most people are not interested. If you have, as long as you have brokers that are happy to buy them for you. But then maybe the cost would be higher. It's interesting to see whether this volatility in yield to maturities we found only occurs for specific exchanges. Because if that's true, then that means that the exchange cost seems to be quite high. All right, I'm gonna stop here. We've gone on for quite long enough. I've recorded this. I don't know how I'm going to be able to post it. Maybe on YouTube. Maybe there's a Twitch way to do it for anyone to be able to see it. Someone's wishing me happy debugging. Yeah, I wish. All right, this was quite fun actually. I've enjoyed it. Hopefully we'll be able to go forward with this next time. What are we going to do next time? I'm finished with the yield to maturities. I might run it with different stuff. I'll actually, it takes quite a long time to find the correct yields. The correct bonds. I've showed you how I've done it with the navigator, but if I scroll all the way down to the end, I've showed you right there. This is just a note. There you go. I wrote a note at the very end to say, look, it took me a very long time to actually go through all of it. These are all the bonds that I found that I thought could be interesting, and these were all the ones that came out. And out of all of those, I only picked how many? 14, 13. So not that many. I don't even know how many there is in there. So it's quite a long process, which you can automate, but unfortunately there's a little bug in the back end, which we're aware of and we're working on, and I want to wait for that to finish, and then I'm going to update my article based on it. So no, I'm not going to look at another example. Oh, I might just one example, just for the kicks, and then move forward. Look maybe at this arbitrage that I was speaking about. I'll speak about that because that's really interesting. I did not expect this. This is quite interesting thing to find. Yeah, that's it. So I hope you have a good one. I'll see you next time, and it will be a good one. Probably next week, same time next week. I'm going to do a weekly thing. All right. Have a nice day.